Welcome to the Whitwam Wealth Real Estate Podcast. Today's episode is Don't Miss Out Why You Should Buy Now.
Welcome to the Whitwam Wealth Real Estate Podcast with Scott Whitwam, your blueprint to financial abundance. Settle in as we explore the mindset and methods for wealth building through real estate.
Welcome back. I'm Scott Whitwam. Don't miss out why you should buy now. This is a really good topic for us to be discussing today, I believe, because I've got 5 reasons that I want to cover today and some things I want to touch on. Because I've heard from investors that, hey, this is not a good time to buy. I mean, I know there's some reality out here. When I talk to my hard money guys, their foreclosures are higher than they've been in decades, really, because investors are having a hard time finding places to liquidate their assets. For the buy and flip guys, the buy and hold guys, they're having higher vacancies, and so it's not producing maybe the revenue that it has been. But we've come through 3 years of probably some of the toughest real estate markets that I've experienced. I've been doing this a long time. I've been doing this over 30 years. So some of the toughest real estate markets that I've had the opportunity to be involved with. So I want to talk about these 5 things and the reasons why you should be looking at buying now. First off, action always trumps inaction. What does that mean? Well, if you're a real estate investor and you're not out digging and trying to find the deals that fit into today's market, you're breeding inaction. And when the market turns, and we're going to talk about why I think that it's getting ready to turn, when the market turns, your inaction is going to put you behind the curve. Action always trumps inaction. There are deals in every market. It doesn't matter what the economy's like. It doesn't matter what the sales volume's like. It doesn't matter any of those things. There's always opportunities in any real estate market. But we got to take action. You got to start getting more engaged with your investor groups, getting more engaged with maybe your marketing. Maybe there's some marketing that you've pulled back the last couple of years. Maybe you need to re-engage that marketing. Maybe there's some things that you were doing when the market was really good in 2019, 20, 21, and you've pulled back on doing those. Maybe you've gotten rid of your administrative staff. Maybe it's time to start looking maybe at filling some of the tasks with virtual assistants, some of the things that you've taken on yourself. But if we remain in inaction, it will lead to more inaction. So action always trumps inactions, and you got to start making offers. Sometimes we are at a place in the real estate market and economy where we got to make some what we'd call stupid offers, and just realize that where you're used to a certain level of rejection rate, maybe that rejection rate goes up higher because you're looking for opportunities that fit within the current marketplace. And therefore, when the market changes, it will put you in a really good position to have leveraged into what's about to happen, I think, into the economy that is coming with us. So action is number 1 because it always trumps inaction. Number 2 is interest rates. You say, well, interest rates are horrible right now. If you listen to the news, you'll see that mortgage rates are tipping 7% again. Buyers are out of the market because interest rates are really bad. And why would I want to get into a market that has that headwind, the headwind of interest rates? But I think this is a really good opportunity because interest rates are not going to stay where they're at. Interest rates are being driven by the current bond market. And the current bond market is going contrary to the Fed's interest rate, levels. And that's not going to stay that way forever because I think there's some changes that are coming in our economy that are really going to really change this. I was looking at some of the historical numbers for interest rates. And as we're tipping 7%, and for the last 6 months, we've been bouncing anywhere from about 6.25% to 7%. They started to drop back in September. They've come back, And every time the Feds cut rates because the economics weren't there to do it, the bond markets have reacted adversely and gone up. But when I was looking back over the last 5 years, and I went 10 years, and I went 20 years, I was starting to look at some of the interest rates in which we invested in. And even at 7%, we're below the last 50 years median interest rate. Do you realize that when we get to 1980, interest rates were, as a median, 12.82%? 12.82% was the median interest rates. Top interest rates were over 18%. And yet people were still able to, now I wasn't investing then, but people were still able to invest into that market and produce profits because they were being active in scaling their offers. Now, the biggest headwind that we're facing right now with interest rates is all of the sellers who have very low interest rates. They've got interest rates, some of them, I just met somebody the other day, they've got a 2.25% interest rate. Well, it's hard to convince that person they need to sell their house when they've got a 2.25% interest rate and tell them to go buy a house at 7%. That's 4.75 point loss. When they go into the new market. So really right now is the discrepancy. But I think interest rates are going to start to come down because of some new economic policies that are about ready to be implemented. And in fact, as we're in the process right now of getting there, energy's being unleashed. We got manufacturing that's going to start coming back again. And we saw what happened in 2016 and 17 and 18, really, when this happened. Is that things started to change, even in the run-up to the change in the presidents at the late part of 2016. We started to see change. We started to feel the impacts in 17, 18, and 19, and that carried us over even when COVID hit in 2020. So I think you're going to see interest rates adjust. I think you're going to see the bond market start to react to new economic policy. You're going to see actual employment rate numbers start to come up. You're going to see more employment as far as getting closer to full employment in the United States. That's going to help bring the bond market down. And I think we're going to actually get hold of the inflationary things that have driven up inflation, 27%, in the last 3 years. We're going to get hold of those. So I think interest rates are a good thing to have right now because there's some opportunities to be ahead of the drop. Because what happens when interest rates drop? You get a lot more competition into the investing areas and into the retail areas. So for buyers who want to buy retail, now they've got multiple offers they're dealing with when they deal with lower interest rates. And we as investors, all of a sudden, all the investors that stayed on the sidelines will start coming back because they'll see the opportunities out there. So we want to be ahead of those. And that's a reason why we should be looking at buying now and not waiting for things to get better before we jump in the market. Let's get ahead and take advantage of some of those opportunities. The other thing, number 3, pent-up buyer and rental pool. I was looking at some recent statistics on buyers and renters, and we have an incredible pent-up demand in both areas. Over the last 24 months, we've seen a number of eviction rates go up. But the problem is what's happened, the same thing that happened during COVID, is that people who got out and started renting again have started moving back because the economy's been so bad and things, and there hasn't been enough options in order for them to fill or purchase the homes that are available because inventories have been low. I mean, it's just been a real mess the last 3 years. But now there's a lot of pent-up buyer, anxiety. They're hoping that interest rates drop a little bit. They're hoping that more properties come on the market, that and create a situation where maybe even prices would stabilize a little bit. We've seen that over probably the last 6 months. We've seen prices start to stabilize. We're not seeing huge inflationary jumps, which I think is really good for our economy. But you want to be the person who has the inventory when the buyers start coming back into the market. You don't want to be the one going, oh, man, buyers are back in the market. Now I got to go find deals, and now you're fighting all the competition. I mean, we've acquired several deals here in the last quarter simply because we are anticipating where this market is going. And again, we made offers commensurate with where we are today. So we're hoping that, you know, the back end will be where we receive the benefit for taking, you know, the risk that we take as real estate investors. And the same thing with the rental pool. There's a lot of renters out there that are looking for, you know, properties. They want to, you know, get into, you know, something. They're tired of living with 3 or 4 roommates. They want to get into their own rentals. Maybe they've you know, now have a family they didn't have before. It's been a lot of stuff that has caused it, and having a limited availability to rentals has also caused a lot of pent-up frustration in that area. And I think you're going to see in 2025 and 2026, I'm kind of with the CFO of NAR on this. I think things are going to be changing, and we're going to see some real demand in those areas. So that's number 3, pent-up buyer and rental pool. It's the reason why you should be in this market now and get ahead of things, because action always trumps inaction. Number 4, days on market in most of the country benefit getting in now. What does that mean? That means sellers right now are a little bit frustrated. For people who have to sell reasons, which means they've either got a job relocation, maybe they've got a financial condition, you know, they've been unemployed, they need to get someplace, you know, or get rid of at least their property. Maybe they can't afford to make the payments anymore. They've lost a job. There's a lot of reasons why people need to sell. So we've got have-to sellers. The problem is in most of the country, have-to sellers' properties are staying on the market significantly longer than they have in the past. And so days on market continue to be an issue for sellers. Well, that creates an opportunity for investors, because you can be the knight in shining armor. You can be the investor that comes in and goes, hey, I know you've got an issue. You've got this foreclosure notice you've got to deal with, and I can help you out. Let me take that off your hands. Let me buy this thing. Let me give you a solid offer. And it gets you active, gets them out of a situation, and it starts to put you in a position where you're ready for the change in the market that is coming. I just think there's a lot of opportunities out there, because on days on market, you know, several of the properties that we've recently acquired, you know, were people that were not able to sell their properties, you know, in the normal course of the obviously condition. They couldn't go on the MLS. Ones that went on the MLS, nobody wanted them. Even though there's low inventory, people are expecting for the prices that people are asking now to have something better, and it's created some opportunities. If you're a buy and hold investor, it has made MLS deals a lot more, I guess, number friendly. You got sellers that are willing to you know, pay for repairs, help buy down rates. If you're using traditional investor financing, they're willing to negotiate on price because their property's been sitting a long time. They have to. I just think days on market are the 4th reason why we should be buying now, so that we don't miss out. All right, number 5, all signs point to a coming real estate recovery. I think that what we see that has happened in the last 6 months in the bond market, I think that what we're seeing with public policy proposed changes that'll be coming with the change in presidents, a lot of times that would just bring stability. Election years can cause a lot of turmoil. I think stability is going to help people be more confident. We're already starting to see consumer confidence rise, which is important in the real estate market. People have to be confident if they're going to spend, you know, $200,000, $500,000, $700,000, $1 million on a house. They've got to be confident that the economy is going to be strong. And I think we're starting to see the signs of that already. I think there's a coming real estate recovery. We have been in a real downturn significantly in 23 and 24, but it began in 2022, about May. So almost 2.5 solid years we have been in a depressed real estate economy, but I think that we're about to see some changes, because I think you're going to see interest rates. They may not get back to where they were before. They may not get back to 3%, 3.5%, but I think you're going to see 5% and maybe sub 5%, which is historically at the very bottom scale of rates. And I think it's low enough that it makes somebody who's got a 3 or 3.5% mortgage go, well, I'll sell my 3.5% mortgage house with a mortgage on it, my apartment complex with a 4.5% and go reinvest it at 6% or 5.5% versus going from 3 to 7%. I think that there's a much smaller gap, and people will make that move. I think that what you're going to see, I think you're going to see some changes at not only the Fed, but I think you're going to see some changes at Treasury. And even though the chairman of the Federal Reserve said he's not stepping down, I think there's going to be way too much pressure. He is really the mastermind who crafted the real estate economy we've had for the last 3 years. And he's the one that crafted the inflation along with the public policy that was being proposed. Now, I know there was some lingering effects from COVID. I get that. But almost on every turn, Jerome Powell has been on the wrong side of this. We've seen interest rates, up almost 2,000%. I mean, it's just incredibly insane. And now we're seeing cuts in the Fed rate when we don't have the economics to support it. So I think that you're going to see the incoming administration push really hard to get the Fed to resign, get somebody in there who believes in growth, somebody who will better support the economic policies that are being proposed. And all signs of that point to a coming real estate recovery. So don't miss out. This is why you should buy now. That's all I've got for this week's Whitwam Wealth Real Estate Podcast. I want to thank you for taking time to join me today. I invite you to subscribe and become part of our growing community. And leave us a review. If you have any questions, we'd love to hear from you. You can always find the Whitwam Wealth Real Estate Podcast on Apple Podcasts, Spotify, iHeart Podcast, and YouTube, or wherever you like listening to your podcast. This is Scott Whitwam. Be sure to join me on our next episode of the Whitwam Wealth Real Estate Podcast, where we're wealth building through real estate.